and calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls on their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Good morning, everyone. Welcome to the opening playbook for Monday, October 13th, 2025. Hope everybody had a good weekend. Nathan, I hope you had a good retreat.
Yeah, man. It was
How you doing?
awesome. Glad to be back. Hope everyone survived without me. Dave, I know you struggled,
Barely.
but it is good to see you. Obviously, missed quite a bit of pandemonium, if you will. It seems like every time I go away, the market goes nuts. I don't know if it's just waiting for me to get out of the way, or
We need to
what's going
build-
on there.
We need to build an indicator around your vacation time.
Honestly, the last time that I went away for multiple days was when we did Pebble. We went to Pebble and the market dropped like 6% in 2 days when I was on that trip. And then there was one other trip. I tried to remember another golf trip. I think a lot of golf trips worked in there. Where it was like one of the worst down days in 3 years or something when I was gone. I was just thinking, man, maybe I need to put on some huge put orders and plan a vacation or something, because the market seems to not like it when I'm gone.
None of us like it when you're gone, Nathan.
Well, there you go. See, that's what I like to hear, Dave. But yeah, so I'm just kind of catching up, honestly, just getting my bearings on a lot of things, both within our company and obviously within the stock market as well. One of the questions I had for everyone here, if you are following jump trades, I'm curious if people hit the target on the jump trades meta position. Could someone let me know if you guys hit the target on that? That was I think it would have hit Thursday, but I was going back and trying to find where my entry, and I didn't get to actually dig through yet to see. So I just popped up, and I was looking at Meta because it was at 7:35. 7:35. Yeah. Okay. Edward said no, but actually looking at it, yeah, it definitely. Edward, you had the target because it actually, now looking at it, it definitely had to hit the target, right? At 7:35. Um, but anyway, Glenn said 227% on Meta. Well, that's good. Let me know if anyone else is not, because I'm looking at it now. It hit $735 on the day of expiration, so I'm assuming that one had to hit. But Glenn said no, and John G said no. So interesting. Okay, well maybe somehow it didn't, but that's 7:35:30. And then the other thing, obviously, is that the nuclear stuff is just on a tirade right now, which is obviously on our list here. We had UEC, CCJ, Oklo all on our list recently. Those are on fire right now. Graham, I almost had a super lucky trade on Oklo because I had that debit spread position that I had opened for like 3 weeks or something, and wasn't even paying attention Friday because I was at the conference.
Mhm.
And Oklo finished, I think, right around 147. If it would have finished below 145, I would have got assigned about 1,000 shares of Oklo on accident, which would have been a really nice Monday to come
That's
back
funny.
to.
I was just about to say the same story. It happened to me on Nvidia.
Oh, no
I
way.
signed $40,000 of Nvidia shares, which I used some buying power up in my
You lucky
trading
duck.
account. But I cannot complain that happened. It worked out
You
good.
lucky duck. Yeah, sometimes those are I don't recommend them, but
Hmm.
sometimes they're the best thing that can happen there. Looks like we had a couple profit pairs that hit as well. So and then some things across the board that went the other way. My CLSK trade looked like it lost quite a bit of momentum, but it's trying to make its way back up. And I'm so far in the clear now that I don't think that even um, dropped a whole lot. What else did I miss, Graham? I'm just literally in catch up mode right now, trying to figure out what all I missed on some of the crazy days. I was mentioning this seems to happen every time I leave. We have wild days in the stock market.
You missed. I'm not going to get too into it, but you missed. Did you see on Friday someone opened a new account, shorted a whole bunch of Bitcoin 30 minutes before Trump's tweet, cashed out about 2 hours after the tweet for $200 million, then deleted that account?
No, I saw the crazy drop, and I was thinking, I wish I was at a computer because I would totally buy Bitcoin right now at like 109, 110. I was actually telling a couple of buddies like
It's 103.
this should have been like a buy the dip for sure. Well, yeah, that doesn't seem sketchy at all.
No, not at all. It's a wild time to be alive.
It really is crazy. It
And
really
I don't, as much as I would love to say it was Nancy Pelosi, I doubt Trump has given her any sort of tips there.
yeah, good point. Well, a lot of wild stuff going on across the board. Obviously, seeing the big rebound. I don't know if you guys did any buy the dip on Friday, if it was still too chaotic at that point, but it seems like once again the buy the dip right now is in full effect.
This was I missed, so I was busy on Friday. Obviously, neither of us made it to closing playbook. We had Dave do an awesome session, just kind of a overview of opening playbook, the memberships, everything we got to offer, which was very nice. But I did post this in my Telegram Saturday morning. It was actually shared by Morgan. And you guys know I like to follow the data, right? That's what I've been preaching to you guys over and over again. We can't predict the future. No one can predict the future, but we know, all right, if we know what's happened in the past, especially when it's happened over and over and over and over and over and over again, we can have a really good idea of what may happen in the future as well. So here we have a stat over the last 25 years. When the VIX has popped 30%, the next 2 trading days, we're up 98% of the time.
Wow.
So that Friday, we had that VIX pop over 30%. That means there was a 90% historic chance that we'd have an update over the next 2 days, and obviously today's a pretty stinking awesome update for us. So again, this is why we like to follow the data, follow the numbers, not get too scared by the news and what's going on. Obviously, news can be scary. This could have not worked out. The markets could have gone lower. There could have been worse news over the weekend. But if we just play the odds, play the edge, over time, I think it can stack up nicely. So that's just my one little pointer for you guys today. Obviously,
I wish I was in position to buy the dip on Friday. I've been telling people, I mean, the market can be chaotic, and just when everyone says like, oh, hey, we really are going to be bullish, that we've gone through the zone of everyone being concerned, and now everyone just saying, all right, forget it, it's going to be bullish. It's probably when you're most at risk. But I still think we got to buy the dip every opportunity until it punches us in the face, which will happen. But so far, you'd be like 20 for 20 or something, and then you would take the hit eventually. But that would still put you net ahead. It's actually a little bit of what I want to talk about today, because I've continued to get questions, Graham, about this whole idea of a negative risk reward. How do you trade if a loser wipes out 3 winners or wipes out 4 winners? How does that actually work? How do you approach that? And Dave and I had a good conversation about this. I don't know what that was, Dave, maybe Wednesday of last week, where we just talked about trying to blend it out. What does that actually mean? And so I wanted to put a little bit more context around that idea. Before I
actually talked about it Friday also a little bit in the presentation, of just kind of like not expecting your average win to be what you get on every trade. It's your average return on the strategy, not your average win that you should be expecting overall. Yeah.
Oh, well, that's a lot of what I'm going to talk about and try to put some more context. Brandon said he didn't get the paper. He wanted to know what the score of the Penn State game was. The score is Penn State negative 50 million and James Franklin plus 50 million on his buyout to be fired. They fired James Franklin, Graham. I don't know if you.
No, I didn't. I figured it was a matter of time, but
yeah, he had the biggest buyout in college football history as a coach, and still got fired. So they wrote him a check for $50 million to go away.
That's nice. That's better than getting assigned shares of NVIDIA over the weekend.
Do you think if I did a bad enough job and was annoying enough on opening playbook that you would write me a check for $50 million to go away?
Yeah, I bet you that's how that'd work out.
But yeah,
you're pretty close, Nate.
I was going to say you're really close, so you don't have a lot far to go.
I'm working on it. So yeah, we were having an interesting time in Happy Valley right now.
Not
but
so
yeah,
in the Valley.
What's that?
It's not so happy.
In the Valley. In the sad Valley.
Yeah, sad Valley.
Anyway, all right, guys, let's get into our business for today. Got a couple of things I want to mention specifically on that negative risk rewards. One that I've continued to get questions on. Just want to try to give you a more practical understanding, because especially for me, this is very important for me, because I am, often trading with a negative risk reward. And sometimes people kind of panic about that. And I want to walk you through a little bit of how to put that into practice. So we'll cover that. I might have a couple trade ideas. Honestly, I haven't got to look probably quite enough, but a couple of ideas have popped up that I saw that I thought might be interesting. And then we're going to try to see if we can actually get Jeffrey to jump on short notice here and just talk a little bit about what he did, because I don't know if you guys got to see the presentation yesterday. Pretty phenomenal what Jeffrey's been putting together. And so we're going to try to see if he can pop on kind of last minute here to mention that. But let's go ahead. Someone said it wasn't bigger than Jimbo's. Yeah, maybe it was the biggest in the Big Ten, but I think it started out right at 80 million, but it works down every year that you actually fulfill the coaching. And then Michigan State also had their massive one as far as buyouts. I think it started at like 85 million, but then he coached for 3.5 years or whatever since then. Anyway, stop getting me off topic in the chat, guys. We're supposed to be talking about trading now. Okay. So one of the things that I tend to get flack for is trading with a negative risk reward. This is one of the things that I get emails all the time. How do we do this? What's going on here? So first, let's say, what does a negative risk reward mean? Well, basically all that means when we say negative, we mean your average loser is larger than your average winner. So your typical loss, your expected loss when you're on the losing side, when you average all of the losers out, is actually a bigger number than when you average all of your winners out. Now, a lot of you have probably heard people say something like, your winners should always be bigger than your losers. This is something that I heard a lot when I started trading. I had a guy who actually, who was a great trader, and this is one of his things, but it was confusing because once I actually went through the data and understood it, it turns out that was not true and didn't make any sense. But it was his personal style of trading, which were great, but he started applying that more generally. The truth is, risk reward does not mean anything on its own, okay? If you take a look, you could have trader 1 and trader 2, where trader 1 has that average winner of 100% and an average loser of 50%. And then trader 2 has an average winner of 50% and an average loser of 100%, right? So trader 1, his winners are twice as big as his losers. And trader number 2, his losers are twice as big as his winners. So who's going to be the more profitable trader? Well, obviously, we don't know, right? Because we don't know their win rates. So you can see, I mean, just literally this slide alone kind of tells you everything you need to know about this concept, is that you really don't know whether trader number 1 or trader number 2 is going to be more profitable because it's a one-dimensional aspect. Now here we find out that trader number 1 made $2,500 over 100 trades at 1K per trade. And then trader number 2 made $12,500, so about 5 times more profitable. So how did the guy with lower, with bigger losses and smaller wins make more money? Well, of course, he won a higher percentage of the time, right? Now, even a more extreme example would be something like trader number 1 with the same stats, 100% and 50%, versus trader number 2, where his average winner is 24% and the average loser is 88%. So more like 4 times, closer to 4 times the average loser compared to 2 times. And this time, trader number 2 still was about 4 times more profitable than trader number 1. How? Well, obviously, his win rate is going to be higher. In this case, trader number 1 still had that 35% win rate, but trader number 2 has an 88% win rate, right? So this should not really surprise us. Sometimes it throws people off, especially if they've heard over and over again, you got to make sure, let your winners run, cut your losers short, or your winners should always be bigger, or whatever other, kind of cheap phrases people like to throw out there. It really shouldn't surprise us because we know, for example, like high frequency trading algos are among the most profitable firms in the world, right? And their entire model is to put millions or billions at risk to generate pennies on the dollar. So clearly, they have a massively negative risk to reward. They're risking massive amounts of money to scoop up pennies on the dollar. Why? Because their win rate is so incredibly high that it makes sense to put the risk on the table for those quote unquote lower returns, right? Does that make sense? If the probabilities are good enough, it's going to justify the risk reward. Now, here's what CFTC report says. We focus on alphas, abnormal returns, which provide a better sense of risk-adjusted performance compared to absolute returns. Okay, so risk-adjusted performance. Alphas are reported for various specifications, so we emphasize the 4-factor. Okay, they go into what their alphas are. And here's what it says. The average high-frequency firm has an abnormal return of 39.9%. If you compare this to the absolute returns, the breakdown among the subcategories is striking. Aggressive high-frequency trading alphas earn 90.6% compared to passive with 28 and 23. Okay, so all of that fancy language about alphas and Carhartt momentum and all that stuff, what they're basically saying is the more aggressive they are with the frequency, the more they're going to stack up net profits, okay, which makes perfect sense because as long as you have a positive expectancy, then the amount of times you can slam that positive expectancy over and over and over again is going to be to your advantage. This is an interesting one. It says Citadel Securities had people generate, 1,700 people generate an average of $1 million in about 3 months. And all they're doing is taking the other side of trades. They're market making, which means they're putting lots of risk on the table to collect smaller premiums. So again, just to be clear here, those are two examples of negative risk reward firms that make millions and billions of dollars. It should show you that risk reward is just a one-dimensional metric that means nothing on its own. Ultimately, this comes down to understanding what risk reward actually is, okay? Because by definition, the risk reward needs to have probability baked in. If you're in poker, you would call this pot odds, right? You would say something like, okay, I have, a 45% chance here to hit the flush, right? I've got 4 clubs and I've got the turn and the river still to come. So 2 cards left that could both be a club. So I've got, 45% chance that I'm going to get a club. And there's 4 other people who have invested in the pot. So I can make like a 4-to-1 risk to reward ratio. We would call that pot odds. My percentage of winning is negative. It's not above 50%, but because the risk reward is greater, it's worth staying in the hand. And in most of my strategies, this is systematically baked in. But let's just do an exercise to bring it home in a practical sense. All right, so go ahead and put your answers in the chat, and we'll do a practical exercise here and see if we can make some sense of this. If you buy a $99, $100 debit spread for 25 cents, remember that spread can be worth $1 because it's 99 and 100, and you have a 50% chance to win, should you take the trade? Again, that's you can buy it for 25 cents, and it has a 50-50 coin flip chance to win, should you take that trade? On a $99, knowing nothing else. All you know is that it's going to cost 25 cents. It's going to be a coin flip outcome. Should you go ahead and take the trade? Right. Yes, you guys are correct. The answer is yes, because a 300% win, which is what it would be, far exceeds a 50% profitability, right? If you could trade a coin flip over and over and over again, and the chance to make 300% was your average win, you would take it, right? So if Vegas came out with a game, they said, hey, new casino just came out with a game. You can fly out to the casino and you can flip a coin. And the way it works is every time it lands on heads, we pay you 3 times what you bet. Every time it lands on tails, you lose what you bet. Who here would go play that game? I don't know about you, but I would be on the first flight to Las Vegas and I would be emptying my bank account to go play that game in Las Vegas. Why? Well, because over time, I would make as much money as I want. I would make millions and billions if they would allow you to go to the limits just flipping a coin. Because the 50-50 odds that pay 3-to-1 on one side are going to be monumentally profitable over time. If you win $75 half the time and the other half you lose $25, you're going to be very profitable, right? 3-to-1. In fact, if you just do 50 trades at 75 and 50 trades that you lose 25, you're going to make $3,750 and you're going to lose $1,250. So over time, this would be a massive net profitable edge over a series of trades. All right, what about this one? If you can buy a $390 spread and buy a $390 call, sell a $400 call, so that could be worth $10, and you could pay $5 for that with a 50% chance to win, should you take that trade? Okay, so it's a $390, $400 now. That means it's a $10 wide spread. You could pay $5, and it's also a coin flip trade. Should you take it? Well, no, because there's not a net advantage, right? 50 trades at $500 winners and 50 trades at $500 losers, you're just going to end up at $2,500 in profits and $2,500 in losses. So there's no net advantage there over time. All right. Okay, what about this one? Let's say, this one's a little more complicated. Get your calculators out. Let's say that you can buy a 245, sell a 250 call for a debit of 375. And here you have an 86% chance to win. Should you take that trade? And by the way, stick around for a moment because I'm going to walk you through something that I think will hopefully make this even more practical for you. Okay, so this one takes a little more math. You're going to have to pull out your calculator if you want to get a good idea of this one. But the trade could be worth a maximum of $5. You're going to pay $375. That means you're going to have about $125 left in profitability. Should you take it? Yes, because 86 winners at $125 is going to equal $10,750 in gross profits. And then the other 14, so remember, this is 100 trades, 86% win rate would mean you'd win 86. You would lose 14, and you would lose the full 375 on those. That equals $5,250. So again, if you could trade 100 trades and you can win 10,000 on the gross, lose 5,000 gross losses, your net win is going to be significant. So a lot of times someone's going to email me and say something like, Nathan, one loss wiped out 3 wins. This is never going to work. How could you possibly trade like this? But while those losses are frustrating, guys, that really has nothing to do with whether a strategy is profitable. When you say, hey, one loss wipes out 2, or one loss wipes out 2 wins, or one loss wipes out 4 wins, or even one loss wipes out 10 wins, it might make you feel like that means a strategy can't be profitable, but it actually has nothing to do with whether a strategy will be profitable. And if you guys are interested in trading mechanical strategies, this is one of the things that you'll have to get through your mind, whether you're trading with a negative risk reward like I typically end up doing, or trading a positive. Let me pause and ask another question in the chat. Please use the chat and engage so that I'm able to get a feel for people in the room. It's always helpful to get real feedback so I kind of know where you guys are at. Let me know in the chat, yes or no, if you are someone who is interested or hoping or wants to trade mechanical strategies, at least some of your strategies. So you at least want to trade some strategies that are fully systematic. You're not guessing on entries. You're not guessing on exits. You're not using discretion on risk. You're not using discretion on timing. You're simply saying a set of rules give you your entry, your exit, your risk, your net profitability, etc. That you at least want to have some strategies that are mechanical and systematic in nature. Now, I know that's not true for everyone, but I assume it's true. Okay, most of you have said yes. Looks like so far at about 50 of you or so have said yes. Now that's, for me, the vast majority of my trading is that it's very systematic in nature. I really want to take myself out of the equation as often as I can. So if you can't handle that scenario, you definitely shouldn't trade those kinds of strategies, right? So in other words, if you look at a strategy and you say, hey, it has an 86% win rate, but the losses are bigger than the wins, I like that it's profitable over time, but when a loss wipes out 3 winners, I'm going to freak out. I'm not going to be able to handle it. Just avoid those kinds of mechanical strategies. But understanding what risk reward actually is and then applying it with confidence, in my opinion, is the real key here. Okay, so understanding what it is, how it actually works, and then applying it with confidence is the real key. Whether that means continuing to swing the bat, quote unquote, after one loss that wipes out 4 wins, because the edge is still legitimate as long as the win rate is high enough, or could be the total opposite, right? So continue to swing the bat after 4 losses in a row because the edge is still legitimate on a very positive risk reward, right? So keep in mind both scenarios. Let me go back. It could be, hey, I got to stick to the strategy, even though one loss wipes out 4 wins, which is hard for a lot of people. Or it could be the opposite. It could be, okay, I have to continue swinging the bat, even though I just took 4 losses in a row, because my winners are bigger. And if I win 2 wins in a row, I'm still going to be net profitable. So again, think about it. You can let me know in the chat if you want, or you can just think about it. almost everyone will find themselves on one side of this equation or the other. And you should determine which one you find yourself on. Some people have a really, really hard time when one loss wipes away a week of wins. Other people have a much more difficult time losing 4 trades in a row and continuing to take the next entry. So again, you guys can let me know which side you are in the chat. You don't have to. You can just think about this. You can write it down on a sticky note. But just be honest with yourself about where you fall on that spectrum, because that will end up dictating what kind of strategies you yourself are personally more capable of executing. And if you set yourself up for failure by trying to trade a strategy that you are not capable of trading, well, then you're not going to be happy, once you have to go through the peaks and the valleys because of that. So you're setting yourself up for failure. Now, it's not that one of those is better than the other. It's simply understanding the system and then executing. So it's not that the high hit rate, negative risk reward is better. It's not that the lower win rate, positive risk reward is better. It's that each one operates very differently in terms of system, in terms of kind of the cadence of winning and losing, and certainly very different psychologically. And so understanding kind of which end of the spectrum you find yourself on psychologically is really important. So what does executing actually look like in practice? So the big thing to understand about trading anything mechanical is going to be the blended expectancy. Okay, so the blended expectancy is really what matters. Meaning, if you have a high hit rate strategy, let's say 85%, and you win 3 trades in a row at 25% each, guess what? Like Dave was saying, that doesn't mean 25% is your expectancy. It feels like it's your expectancy when you win 3 or 4 trades in a row, but it's not your expectancy. And this is, I think, where people get really messed up, because they think, oh, well, 25%, that's what I win. And so it feels like that's their expectancy, but it's really not. You have to blend it with the losers and create your true expectancy, and then get used to that and then kind of work forward on that as your true expectancy. So it might look something like this. And I think a lot of people right around trade 9 here are thinking, hey, this strategy doesn't even work. The losses wipe out all the gains, right? You win 3 in a row, oh, you lose, you're down. You win 4 in a row, oh, you lose, you're down, right? So I think this is where people really struggle, because through 9 trades that you would have won 7 out of 9, and you would actually be down $250 in your account. So let's just be honest. Let's just be very, very honest with ourselves. How many of you in here, after winning 7 out of 9 trades and then being negative on your account, would already be pretty fed up? Just think about this. Let me know in the chat if you want, like I said, or just think about it, if you want. But how many of you in here would, after winning 7 out of 9, look at your account and be negative and be like, you know what, this is ridiculous? And you'd be totally fed up at this point here in the series of trades.
It's funny because much of this could be right out of what I talked about on Friday, which is good because it's reinforcement. Not everybody here, well, you're going into it in more detail than I did, and not everybody that's here was there for Friday. But yeah, we talked about this a bit, and I talked about the fact that what if we had, something where it's, you're going to double your money every week. Averaged out, winners and losers, your average return is 100%, but you're only winning 3 out of 10 trades. Can you stomach losing 7 out of 10 trades to double your money every week? And if that's not for you, then it doesn't matter what the strategy can do, because you're never going to be able to stick with it. You're always going to be trading wrong and trying to bail yourself out and messing up the strategy.
Yeah, absolutely right. Okay, let me walk through then what this actually looks like. Okay, I got a lot of honest people in the chat. Good, that's good. Okay, 7 out of 9, you're negative. It's very annoying, by the way. I feel like sometimes people say like, oh, that's because you guys are weak-minded and foolish. Like, no, it's very difficult when you're in that situation. But the thing about this, guys, this is what I want you to take home. You have an 85% win rate, and you have a positive expectancy by 25% winners and 100% losers, winning 7 out of 9, having 2 losers in your first 9 trades. That's within a very normal kind of mathematical cadence of trades, like very, very normal. In fact, you could lose 4 out of your first 9, and that's actually not outside kind of the standard deviation of what you would expect with an 85% win rate that might happen once a year. Now, this might happen like 20 times a year, the 7 out of 9, but like even losing 3 or 4 out of 9 is pretty close to a standard deviation over a set of trades. So a lot of you in here said you would be fed up. And again, I understand. I think I would put myself in that same boat not that long ago. But you're being fed up within a very, very normal set of trades. The key is over time, you should hit your expectancy, right? That's the whole idea. Over enough trades, the expectancy balances out. Now, I did this where that's exactly what happens. Over 20, we get right back to our positive expectancy. We have 3 losers. That's 15%. We have 17 winners. That's 85%. So if you do the math, 17 times 250, 25%, 3 losers times 1,000, negative $3,000. And so again, you get the 85% win rate just as expected, okay, over the course of 20 trades. So what's the problem? Well, when you blend it all together, it doesn't feel nearly as good as it felt to make 25% every time like when you started out. And I think that is the real challenge for most traders. When you go on a run of winners, you kind of feel like, hey, this is what I win when I win. But when you blend it out, it doesn't feel nearly the same. Even if you knew the numbers going in, once you kind of compare and blend it, it doesn't feel nearly as good. The net result would be $1,250 over 25 trades. Or 20 trades. I don't know why I wrote 25 there. Over 20 trades. Okay, let me fix. Over 20 trades. So that's your net result. Now, if you took 3 trades and made $750, again, you don't feel like at 20 you're going to be at $1,250. You feel like at 20 you're going to be at $4,000 or $5,000, right? Again, this is just the mental psychology of this, but that's the math. $1,250 over 20 trades. Now, here's the part that I think kind of blows your mind a little bit as we get into what that actually means. That's a percentage of 6.25% per trade. Again, doesn't feel nearly as good as 25%. 6% of trade, no one seems to seem like that excited about it. But let's do the math and assume that these are happening every week. So let's assume this is a weekly strategy, right? Every week, you hit 250 on your winners and you lose 1,000 when you lose. Okay, everyone with me? We're going to assume that these series of trades are happening every week. That would be over 320% annual without compounding week over week. So that's just throwing $1,000 in, right? And having your winners be, stacked up with, I forget exactly what I did, some minor compounding here over the course of, but not compounding, rolling week over week. If you roll it week over week, well, then it gets pretty crazy because it's like, $23,000 of 1,000 week over week rolled into if you compounded 6% every single week. How about a 10-year graph? If you did 6.25% per week and you increased your size every 3 months, 10 years, you go from 1,000 to 9,000 in year 1. You go from 9,000 to 100,000 in year 2. Then you go to 1 million. The numbers obviously get completely out of control. What's that? $21 trillion at the end of 10 years. Anyone want to make 21 trillion at the end? Pretty crazy if you can average 6% per week. I mean, I assume, like me, if anyone could sign up for the guaranteed 6% per week, you would leverage every resource you have and get it into that magical account that does that. because this is what the numbers look like. Now, obviously, I'm not telling anyone to expect $21 trillion, right? Hopefully you guys already know the drill better than that. Winners, losers, fees, drawdowns, all the things, right? But I want to remind you guys of something just outrageously important. To me, this is where the rubber meets the road. Those are the identical results of this same series of trades that a lot of people would have been fed up with on trade 9. Okay? So that graph, the totally absurd potential of making trillions of dollars, which is just, ridiculous. Those are the results that many of us said we'd be out after 9 trades on. They're not doctored up. They're not a better version of the performance. They're the exact same results. Turning $1,000 into 21 trillion, and most of us would have quit on trade 9. So that's what you have to kind of get over mentally, the hump there. Because, again, easier said than done. But I think a lot of people think, hey, 6% a week is actually 6% a week. Well, no, it's not actually 6% a week. It's 25%, 25%, 25%, negative 100%, 25%, 25%, 25%, negative 100%. 25, that's what it actually looks like and feels like. And that's where things really, knock people out. And I hear a lot of people say, hey, the strategy doesn't work, about strategies that I know work, but they are basing it on 9 trades, or they're saying it doesn't work because I thought I would make 50% a week, when actually when you blend it down, I make 2% a week. And boy, do those numbers feel far apart, right? 50% a week and 2% a week feel very far apart, but actually 2% a week is a phenomenal strategy. If you can actually swing the bat and get 2% a week, you'll beat every hedge fund to ever exist in the history of the planet Earth, but it just doesn't feel as good compared to 50% a week. So,
and if I can add on to that, because there was a question or a statement in the chat that Gwen said it would be discouraging. I would just try to adjust my trades so I don't lose so much. The problem is with that is that you're reacting to how the trades went with emotion, and you're going to mess up your opportunity to get the returns that you expect from the trade or from the strategy. You need to adjust it before you start. You need to go into it saying, right, I'm going to dedicate $1,000 or I'm going to dedicate $100. It doesn't matter what the number is, as long as it's a number that you can deal with several losses at that number. Then that's what you need to set before you go into the strategy, so you're not reacting to the results of yesterday's or last week's trade in determining what you put in this week. If you're going to put in 1,000 a week and then you're going to change it to 100 when you lose, you're never going to make back the loss, because you've adjusted the potential wins based on the feeling of the loss. So you need to make sure that you're starting out and you're consistent, and that you play that strategy for number of trades until you grow your account. And then you can say, okay, well, now that I've reached this level of my account, now I'm going to put 200 on every trade instead of 100, and I'm going to keep it consistent at 200. But you can't adjust every trade based on the last trade, or you're never going to get the expectancy that everybody else is getting.
Yeah, it's exactly right. You do it beforehand, you plan beforehand, and as long as you know the numbers, or at least kind of the general expectancy, then you know exactly what your kind of your drawdown is going to be, or at least, again, within reason, what your expected drawdown is going to be, and certainly you know what your losers should look like. And so that's why a lot of times something like over-end options that has a high win rate, and then if you lose 2 trades in a week, like we lost 2 in a week last week, you just feel like you got punched in the face, right? Because those losers are bigger than your winners. And so a lot of people will say, hey, I've got a $20,000 account. Should I risk, 2% of my account or 5% of my account or whatever? And obviously I'm never going to tell anyone a percentage of their account. But often I say, well, maybe just do one contract for a while, just so you kind of feel what the winners and losers begin to feel like, because that's going to be incredibly important to get comfortable with the strategy. If you say, hey, I'm going to go in with 20 grand, I'm going to risk 5%, and then you lose 2 out of your first 3 on a strategy that has a negative risk reward, you're going to feel like you totally got punched in the face on that strategy, and it doesn't work. Now, one of the examples I like to show that's kind of fun is if you look at something like, let me find it here, like this strategy, which is, this 60-day stacking strategy that I always like to show, which just has, crazy results over time, right? And by the way, it has a negative risk to reward ratio, but it turns $25,000 into $37 million over the last 10 years. And so it's a fun one to show because, everyone says, well, there's a strategy I would trade. I would love that strategy. But guys, I can almost guarantee you, if you started trading this in 2022, you'd probably quit on it. You'd probably say, this thing doesn't work. I'm down, I'm down 30% or whatever. Well, actually, in this one, we did small size, so it's only down 12%. But I'm down 12%. I've been trading it for 8 months. I'm down 12%. Clearly, this thing doesn't work, and I'm out. And I'm, I'm not beating anyone up. It's just the reality of trying to stick to systematic stuff and how hard it actually is. It sounds easy when you see the positive numbers and you look at the net return. You look at the final 37 million. It looks easy then, but if you trade for 8 months and you're down 13%, I can just about guarantee most people aren't going to stick to the strategy. So hopefully this gives you just a little bit more context for how to actually approach things. You have to approach things with the mental mindset that's already prepared for what, winners and losers are going to look like, what they're going to feel like, and then be able to, be confident enough that you're going to keep swinging the bat in spite of those things. Because I know for me, that's been a mental challenge, and I know for a lot of my students, if we have lose 2 out of 3 on something like over an options, which is already a negative risk reward, they feel like they're out. Like, this is it. This thing doesn't work, or I can't handle it. And so trying to do that work on the front end, and like Dave said, set your risk up to where you can handle that on the front end. I don't think you can do a whole lot better things for your strategy than that. Because, it's easy to say, hey, as long as the strategy turns 25 into 37 million, I'm good to go. But it's a lot more practical to say, okay, I've been trading for a couple months. I'm down. Am I actually going to keep swinging the bat? And setting yourself up with the risk that can handle it, I think is probably, again, one of the most important things you could do. As a matter of fact, I would say being mentally prepared and kind of knowing what you're trading and being committed to it, understanding what that means, is probably a lot better for you and for the future of your trading than any one strategy or hack or thing you're going to figure out in the market. It doesn't sound as sexy as the 88% win rate, it doesn't sound as good, but it's probably more important for you as a trader and for your future than any single strategy I could give you, any single stock pick I could give you, and all that kind of thing. And with that said, what a beautiful transition into bringing Jeffrey on as far as giving you trades. Because Jeffrey, I assume, I don't know, I know you caught just the last minute there or so, but I would assume this falls into the way that you're trading cash bot as well. You're going to pile up some wins, then you're going to have a loser, then you're going to pile up some wins. And if you start on a day where you lose 2 trades, people are going to say, this thing doesn't work. But it's a matter of what the cumulative results do.
Full transparency, the trade that I put on Friday, I put some shares over the weekend because it went, we went down huge. It doesn't mean the system doesn't work. It's one bad trade, and right. I'm not really sweating it. The next opportunity, it's just, however many candles away, I'm just waiting for the next one. Because over the last 280 something trades from this year, 9 out of 10 work out. So it's just a matter of sitting through a couple losses, and then it's going to make it all back again. It is tough, though, to sit through those bad ones. I mean, we traders have a very short-term memory, 30 seconds. It seems like sometimes, what's happening. You're only good as your last trade.
Right.
So if you take a string of losers, it's hard psychologically to sit there and watch it pile up against you, and not thinking that you should be doing something different. I see this over and over. Everybody wants to fix the system when it takes a couple losses in a row.
We had some people in the chat say exactly that. They say, I would start adjusting. If I was 9 trades in and I was net negative, I would start adjusting the strategy. And that's exactly what us traders want to do. We want to start tinkering
I see it over and over and over.
Yeah.
Already, people are asking me, "How can we fix the cash bot?" I'm like, I just really, I just spent,
Right.
like, what is it? How long have I been working on this, Nate? Like 6 months. I was working on this, trying to build it into,
Right.
we got our German team back testing it to find the optimal strategy. I mean, I tested it, I built the thing, and don't tinker with it. Just
Right.
do it as it
Well,
is.
clearly you forgot to tap the phone line between Trump and Xi, and that's where you went wrong, because that's the only indicator you needed for Friday, but you didn't have that one. And
Yeah, it was 10 minutes later. I got into it, and 10 minutes later, I was like, dang it, what the heck?
Yeah. Some of those have. Well, the other thing I think to keep in mind, and maybe I didn't actually talk about this super deep today, although I kind of mentioned kind of the standard deviation, if you will.
Yeah.
That traders are going to have a tough time with, or tend to have a tough time with. If you win, if you have a strategy that has a 90% win rate and you win 9 out of 10, I think, and maybe we don't do a good enough job. I think we try to be very transparent about this stuff, but maybe it's partly us not doing a good enough job. But I think it's more just the psychological thing. People think every 10 trades you win 9 and lose 1. And it's like, okay, well, that's not how the actual math spreads out.
Yeah, this is more like 1,000, win 900, lose 100.
Exactly.
The 100 could all come at once. That's the tough part.
Exactly. People say 90% win rate. I just lost 4 out of 10. That's a 60% win rate. That's not even close. This thing doesn't work at all. And you got to stretch the math out to get the expectancy to actually hit, and that's really tough for traders. I find
the minimum statistical population is 30. So if you're looking at any set of trades, if you're looking at any set of trades less than 30, then you don't even have any statistics that mean anything. It's all just throw it out the window.
Right.
Yeah. Yeah. Somebody asked in the chat, like, well, if what Nathan was saying is correct, then how do you know when a strategy just isn't working, if you're just supposed to keep going and going anyway? And so what I was going to say is, well, statistically speaking, you have a minimum of 30 to have a real statistically relevant data set. But I think it also depends on what the expectancy is compared to the performance. If I have something that's supposed to be winning 85% of the time, and I've only won 2 out of 10 trades, I think I know by 10 trades, it's not winning 85% of the time. If it's losing 80% of the time, I think I know we have a problem. But if it's something where, okay, it's basically breaking even, or it's a little on the losing side compared to what it's supposed to be, and I've only taken 9 trades, then I haven't given it enough time. I haven't really seen what it can do until we get up to about 30 trades. So I think it does vary a little bit on, what.
Yeah, I would say even 2 out of 10, that you're not necessarily out of the woods. I mean, unlikely. You're starting to stretch that deviation where it's unlikely. But I would say, the thing that I would look at is also the market conditions. Is it losing a whole bunch in market conditions that it should be winning? That's to me.
Is it the strategy, or is it some external factor?
Yeah, like okay, April 2nd through April 6th is a bullish strategy losing. Well, probably yes. And it probably should be losing. That probably should be where it's taking it. If you've got a hedging strategy where you're buying puts and you're losing from April 2nd to April 6th, you might have a problem if it's not making money in that situation, right? So you also to kind of match up, should it be performing in this environment versus, should this be kind of an expected challenge for it? Because I don't care what anyone says. I don't buy the idea that, there's a strategy that works in all market conditions. There might be a strategy that's non-directional, but that doesn't mean it works in all conditions. It might be non-directional that needs high volatility. It might be non-directional that requires lower volatility. It might be non-directional in different ways. So no matter what strategy you have, there's going to be conditions where it's going to do better and it's going to do worse. And so understanding those conditions, or at least having some idea, and then matching up its performance, I think is super important. So
it's like even this brand new thing that I built that wins 90% of the time, this cash bot. If we're in a trend and then we have sudden drops, it's going to do damage to it. Like that's going to be the Achilles heel there.
Of course.
Like we had on Friday. That's, perfect example.
Yeah. Well, let's talk about it a little bit more in practical context with the cash bot, because I think this is actually one of the things that people will like, and I know you'll give a quick intro and then we'll let people go through the full presentation and all that. But one thing I've found, and you can tell me if you've experienced this as well, the high frequency is nice for people to get back on the horse, right? If you take two losers, then you're waiting 6 weeks on the sideline for your next opportunity. That's tough. That's when I see people, hey, Nate, I took this trade even though it wasn't a recommendation because we've been on the sidelines for 3 weeks. I'm thinking like, okay, well, that's you just made a total coin flip, and you could be doubling damage. But with the cash bot, it's like, okay, we're getting back on the horse. We're getting back on the horse. New opportunity, new high probability opportunity. And I actually tend to think, I think I told you a couple years ago, Jeffrey, I thought that would be hard for retail traders when you and Roger were both talking about being more active. And yeah. I think the last couple of years have proven that I'm dead wrong. Actually, retail traders, at least in our world, have done much better. They've said, I'm not going to sit on the sidelines for 3 weeks, panic, and make my own decisions. I'm going to get right back on the horse with new opportunities every day.
Well, a year ago, you were super excited when we were launching Apollo because you were like, this is the perfect thing. It gives people about a month to get in the trade and, see if it works out. And I mean, you were just like really excited. It worked too. Like it still works. It's slow. And I saw, some people, I want to go faster. So I built a day trading version of it that trades 0 days. And then there's a whole group of people that are like, whoa, that's too fast. I don't want to sit there and watch every minute, to see if I need to take action. So taking the, not too fast, not too slow approach, I came up with this cash bot that's high frequency, on average, more than one trade a day. Not up to, not quite 2, but, more than 1 a day on average, possibly up to 3. We've had one day that got 4 so far, and they last about a day. And that seems to be attainable for a lot of people. Is that it's not too fast, not too slow. It's repeatable. If you take a couple of days off, no big deal. There's going to be more trades. They don't last forever. You're not in it for 3 weeks. And I mean, it wins a lot. I mean, I've kind of taken in everything I could possibly think of, really pull it out of my brain to try to make this, just help as many people as I possibly could be comfortable and happy trading in the market every day.
Yeah.
And
well, I mean, I think we'll play the presentation. So if you guys missed it, you can just hang tight right here for a minute. We'll kick it off. But just want to say maybe 2 things real quick. One, if you guys answer that question, that you're more on the high win rate side, that you like the feeling of wins, you like getting right back on the horse with another one, that gives you the confidence to keep trading, then obviously this is more in your wheelhouse. The other thing that I think is incredibly important and maybe even overlooked is that it's mechanical and has the data behind it. So you pretty much know what those expectancies are going to look like. Doesn't mean they're exact. Like I said, 9 out of 10 doesn't mean 9 out of every 10. It means, like Jeffrey said, 900 out of 1,000. Then you might have a group of losers. You might win 60 trades in a row. Like that's how the data actually shakes out. But this is so mechanical and so data-driven that you should have a really good idea of what your expectancies are going to be and have the confidence to follow it. And that's one of the things that I really like about, a lot of the stuff that Jeffrey's been doing lately. That's more algo-based, more mechanical-based, because it kind of gives you that confidence and you know what you're looking at versus, Jeffrey, you've nailed a lot of big predictions as well, but those are kind of hard, right? Because it's like, this is a one-off scenario.
Really hard.
if it's right, it's right. If it's wrong, it's wrong. Here, it's like, hey, here's a new income opportunity every day with a super high probability, jump on, kind of know what your numbers are. So anyway, those are the kind of things that I like. I think that's, one of the reasons I've pushed you and Roger and some others to try to go that next level with mechanical stuff. And I'm super glad to see over the last few years that you've been able to kind of, like you said, pull it out of your brain, get it into an algorithm, and to the point now where it's, not just mechanical, but automated, real time. And, anyone can follow along. I don't want to spill too much out of the cash pot, but pretty stinking awesome.
Yeah, this just, I took all the feedback that people just wanted more straightforward, more simple, more, just take me fishing, show me where to cast tell me what bait to use and where to cast it and how to catch those fish 9 out of 10 times to put this in an analogy. That's basically what this does. I took everything that I do in the background and just, instead of teaching how to do it, I just built it on into the algorithm. And in the masterclass, I'll teach you how, some of the things go, but, most people just want to trade. They don't want to have to worry about all the nitty gritty details. Although the people that do, tend to do better than the people that don't. But
Mhm.
this is going to give you something that you could just go with, and then as you get time and have free time to learn it, you can learn it. So, I mean, that's bottom line. What I built is just something to take you fishing and try to get you out there being successful in the markets.